Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 89 on November 23rd, 2019. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Abercrombie and Fitch, General Motors, and Snap Inc. And then we discuss three new trades on Clovis Oncology, Macy's, and the US Natural Gas ETF. Now, it's always great to hear from listeners. If you have any questions about the trades presented here, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit the website and click on the videos tab to watch them, or just visit the YouTube channel for the Weekly Option. Now, the U.S. equity markets finished the week slightly lower after reaching all-time highs, and the Dow Jones Industrial Average dropped 129 points week over week, closing at 27,875 points. The S&P 500 index lost 10 points, ending the week at 3,110 points. Now, we're going to dive into the topic of the week. The topic of the week is sponsored by the Option Studio. If you want to learn options without any calculus and confusing language, visit the website to learn more about the online course. Visit www.theoptionstudio.com for more information. So the topic this week is the MACD indicator, and this is the third piece of a three-series study of technical analysis. So the MACD indicator has been one of my favorites for, probably 15, 20 years. I've figured out how to use this successfully in my trading. So MACD stands for Moving Average Converges Divergence. So that's MACD, Moving Average Convergence Divergence. And this indicator can reveal changes in direction and momentum. So it is an oscillator. It moves around quite a bit, and the goal is for it to give you a clear view. I use it to confirm trends and also to identify when momentum is shifting and possibly in which direction. So if we've been in a down move and I see a couple things happen, if I see a bullish momentum indicator given, that's typically a sign that the market is about to go higher and that I should start looking to either close my short position or go ahead and buy the stock or whatever I'm trading, a futures contract for that matter. So the main parts of the MACD are what's called the MACD line. There's a signal line, and then there's the zero line. And the most common parameters are 12, 26, and 9. And I'm giving this to you so you'll be able to follow along. So the MACD line itself will be the difference between the 12-day exponential moving average and the 26-day moving average, exponential moving averages. So the difference between those two, if you're using 12, 26, and 9, the difference between those two will actually define your MACD line. The signal line is the 9-day exponential moving average of that MACD line. So it's almost, I started to use the word derivative. It's like a derivative of the MACD line, but I try to avoid words like that on this show just in case it scares some of you off. It really isn't that complicated. So you have this line, and then you have that MACD line, which represents the difference between two exponential moving averages. And then you have this other signal line, which is a function of the MACD line itself. And then I mentioned the zero line, and the zero line basically lets me know if we're in an overbought or an oversold condition. So the oversold scenario is when we are below the zero line, and the overbought scenario is above the zero line. So pretty basic, but there's a lot of information contained in this one indicator. So, how do I use it? Well, a simple trading strategy that is used is to buy the stock when the MACD line crosses the signal line below the zero line, which means if we're below the zero line, that means we're in the oversold. So most likely the stock has been trailing off, and when those lines cross underneath, cross underneath the zero line, that's a strong indicator that prices are going higher, and the momentum may very well be changing. And then another way to use this is to sell the underlying stock when the MACD crosses the signal line above the zero line. So if you're above the zero line, you've been heading higher for a while, and you're in the what's called the overbought. So people have been buying the stock or futures for a while, and when that cross happens, that's a sign that momentum has probably shifted to the negative, to the downside. And if you're already long, it's a great time to exit. If you are not long, and you're just looking to get in the market, that would probably be a key indicator that it's a good time to sell the stock rather than just buying the stock. So now the signal, like any other technical indicator, can give false signals. So I'm a big fan of two things. First off, you have to use these signals, study them, and learn their positives and negatives. Every model that's ever been created has assumptions built into it, and those assumptions, when they become less relevant or not relevant at all, those assumptions can actually cost you. They can render the model useless, right? If the inputs are bad, you can render an entire model that you spent all sorts of time working on useless. And it's the same with these technical indicators. So, each stock you may find that you can change the overall parameters and make this. So don't use 12, 26, and 9. You might be able to alter the parameters and make them more useful to the stock that you're trading so that it gives fewer false signals. It's a model, so figure out what works, and track it over history. But don't just look at these parameters. Like if you're looking at a moving average, it always works out perfectly in hindsight. So the way to test these technical indicators is not just to look at the history, it's also to look at the current and see what the signal is giving today. And paper trade, see if you would actually trade. If you had put the trade on today, what would happen over the next 5 days? So you've got to test it, because it's more art than science, even though we use math to create these technical indicators. And the second thing that I found is that these indicators are much more useful when paired with another technical indicator, just for confirmation of the signal. So if you remember, over the last few weeks, we've looked at simple moving averages. We've looked at Fibonacci analysis last week, and then today a little bit of this MACD, the MACD analysis or indicators. So I'm a fan of using all three, just in varying respects. And so I actually wrote an ebook that I'm sharing on a YouTube channel, another YouTube channel, and I definitely wanted to offer it out to you guys, my listeners, for this option show. If you like technical analysis, this ebook is probably something that you will enjoy. So just email me. You can reach me at eric@theweeklyoption.com. That's ERIC @theweeklyoption.com, and I'll email you the ebook for free. So that's it. Let's dive into the review of last week's trades. And it's definitely a mixed bag. So this should be a good show for that. So we'll start with the covered call. We looked at Abercrombie and Fitch, symbol A as in Alpha, N as in November, F as in Foxtrot. At the time, the stock was trading for $18.45. And I looked at buying that stock and selling the December 19 call at $1.20, hoping for a 9.49 or roughly 9.5% return in 5 weeks. So Abercrombie and Fitch stock fell $2.52 per share, ending the week at $15.93. That December 19 call we sold can actually be repurchased for 43 cents, locking in a profit there of 77 cents on the option. So that leaves us with a net loss of $1.75 per share. And that's one of the biggest things I don't like about trading covered calls is that the stock, because you own stock, you still are fully exposed to the downside. And the amount of money that you sold the call for creates a little bit of a buffer. So we sold that 19 call for $1.20. So we were buffered for $1.20 of this move. Once we moved the other $1.32, we were fully losing. So we have a net loss of $1.75. And, it's been a while since we had one of these covered calls completely blow up on us. And for those of you who have forgotten, you know that our plan is to roll the strike lower by buying the call option that we sold and then selling the current at the money call option. So what we'll end up doing is selling the December 16 call at $1.27 per option. Now, this will mean that if stock finishes above $16 per share, we will lock in a $2.45 loss on the stock and capture a total of $2.04 in option premium. That means that we reduce our overall loss to 41 cents net. So that's only 25% of the loss that you would incur if you were simply to close the entire trade today, right? If you were to close the trade today, you're walking out with a $1.75 loss per share by rolling the stock, rolling the option really lower for a lower strike. You have the possibility of reducing your overall exposure to 41 cents. So that's fantastic. And actually, I said that wrong. It's not that you reduce your overall exposure, because as long as you own that stock can go to zero, right? It typically doesn't, but it can. And so you always have to be aware of it. But what you are lowering is you're putting yourself in a situation where if stock moves higher, you will actually be able to lock in a net loss that's a fourth of this overall loss if you were to close the trade today. So hopefully you guys understand that, rolling the strike lower can truly save you on these covered calls. And if you're not understanding or simply not comfortable with it, just pull out some paper and a pencil and run through the numbers yourself, because it'll make you a better trader. If you understand how all of this works, you will be a better trader, I promise. So let's move on to our second trade last week, which was a credit spread on General Motors, symbol G as in golf, M as in Mike. At the time, the stock was trading for $36.89. We looked at selling the December 37.38 call spread, collecting 33 cents, which can create a maximum loss of 67 cents. So GM stock fell $1.56 this week, closing at $35.33 per share. This is great because the out-of-the-money call spread we sold is now even more out of the money. Now, you can repurchase the spread for 14 cents, and that would mean that you could lock in a 19-cent profit immediately, or you can hold this trade as is for 4 more weeks, because December expiration is in 4 weeks, and you'll be able to capture the full value of the spread if stock stays down here or even goes a little lower. So just remember, the break-even price on this trade is $37.33 per share, and as long as you close that trade before we get that high, $37.33, you'll be able to lock in some sort of a profit, maybe not your maximum profit, but some sort of a profit on this trade. So that'll help you. Knowing the break-even price will help you protect your profits and keep you from turning a winning trade into a loser. And that's just, for any of you that have been trading for a while, you know how hard it is to create profit. You guys hear me week after week on this show. Win some, lose some, make adjustments, keep going. The worst is when you win and then you let that win become a loss, because profits are so tough to continue to make week after week after week. You don't want to lose profits. So definitely watch this trade. If it was one that you looked at or considered or decided to get involved with, hey, it's great, made some money after the week, but if you're not going to close out of it, then definitely make sure you watch it and make sure you walk away with the winner. And then our final trade from last week, trade review, was the debit spread on Snap Inc. Symbol S as in Sierra, N as in November, A as in Alpha, and P as in Papa. At the time, the stock was trading for $13.94 per share. We looked at buying that December 15-14 put spread for 69 cents, which could yield a maximum gain of 31 cents or 45% return in 5 weeks. And this one is not one of my favorite trades at all because Snap Inc. actually grew. The price per share grew $1.32 this week, closing at $15.26 per share. That in the money put spread we bought is actually out of the money now. So you can, it's close, but it's still out of the money. So you can sell the spread for 33 cents, which will lock in a 36 cents loss on the week. Now, I would typically look to sell an iron condor, and that's when you sell a call spread and a put spread together. So I would typically sell an iron condor against this trade. I would actually just keep the spread right now and see if the market drops lower in the next 4 weeks. I keep looking at this chart. You certainly can look at the chart yourself and see if you believe that the momentum is actually going to carry it lower or not. Your maximum risk right now is 33 cents. Now, I looked at putting on another trade. So if I sell a 50-cent wide iron condor for 26 cents, which is available in the market, then I would still be open. I would still be open on 24 cents of risk, right? Because it's 50 cents wide and I'd be selling it for 26 cents. So I'd still be open on 24 cents of risk. And, even though that gets us, that lowers the amount of risk level that we have right now. Right now, we could lose the other 33 cents that we paid for this spread. I still am not certain that this stock is going to completely keep running higher. So I would definitely look at staying in this a little bit longer and seeing. I mean, I'm a big fan as long as stock isn't spiking higher or lower. I'm a big fan of like, hey, let's just take another day and see what the market's going to hand us. It's almost like when you're playing poker and you get the next card in the community and it gives you so much more information. That's how every day of price data is, because whatever happens on Monday will help you know a little bit more than you currently know. You start to know the future. So if you're in this trade, the way I'm looking at it is wait a little bit. Let's see if this market's going to keep pushing higher or if we're going to watch it fall. Because if it falls, and hopefully that's a win, but if it does fall back in, this trade can still end up paying very well. So that's it for last week's trades. Let's go ahead and get into the new trades. I always love talking about the new trades, and it's so much fun knowing that you guys listen and follow along with me. So we're going to bring up a company. Well, let's see. I've got one company I've spoken about or made several trades in, and I have two that I don't think we've discussed at all on this show. So we're going to start off with our covered call. We're looking at a covered call on Clovis Oncology, symbol CLVS, C as in Charlie, L as in Lima, V as in Victor, S as in Sierra. Stock ended the week at $8.66 per share. And I'm looking at buying the stock and selling that December 9 call at 75 cents, hoping for a 12.59% return in 4 weeks. So you enter this trade by buying Clovis stock for $8.66 per share and selling the December 9 call at 75 cents. This trade makes the most money if stock prices finish above $9 per share, and the break-even price on this trade is $7.91 per share. Our next trade is going to be the credit spread. We're looking at Macy's, symbol M as in Mike. The stock ended the week at $15.43 per share. I'm looking at selling the December 15/16 call spread, collecting 17 cents on the spread, and that of course can yield a maximum possible loss of 33 cents per spread. Now you enter this trade by selling the December 15/2 call at 59 cents and buying the December 16 call for 42 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay below $15.50 per share. The break-even price on this trade is $15.67 per share. And then our final trade on the week is a debit spread on US Natural Gas ETF, symbol UNG. U as in uniform, N as in November, G as in golf. So stock ended the week at $20.73 per share, and I'm looking at buying the December 20.5 call spread, paying 31 cents for the spread, and that can yield a maximum gain of 19 cents per spread or 61.29% return in 4 weeks. Now you enter this trade by buying the Dece 20 call for $1.65 and selling the December 20.5 call at $1.34. This is a debit spread because we are buying the spread, and this trade will make the most money if stock prices stay above $20.50 per share. The break-even price on this trade is $20.31 per share. So that's it for this week's show. Thanks so much for listening. Thank you for following along. If you haven't already done it, please subscribe to the show or subscribe to the YouTube channel. Again, if you'd like a copy of my new technical analysis book, I'll email you a copy. Just email me and I will get that in your hands. Thanks again for listening. Feel free to share this with a friend. And as usual, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.